Okay, let's talk about fixed and intangible assets. Sounds a little daunting, doesn't it? Okay, as usual, I will let you take a minute to read over the learning objectives. First, let's talk about what are fixed assets. We've talked about things we use in the business. For instance, our inventory and items that we sell, and how we use those items to reduce our retained earnings. We've talked about other things like rent and insurance and wages and different things that it is necessary for the business to have and to use in order to do what it is they're in business to do. That sentence probably would not impress an English major. Oh well, I do numbers, not letters. Fixed assets are those things that the business needs in order to do their business, but they're not items that are either used up rapidly or that are sold as part of our business. They're items like equipment and plants and buildings and computers, all those things that we need in order to be good at what we do or to do our business successfully, but yet it's not really what we're in business for. So some of the characteristics of fixed assets, and yes, sometimes they seem like characters. Fixed assets are long-term. They're going to last more than a year. Most of them are going to last for an extended period of time. They're somewhat permanent. And some examples, like I've already mentioned, equipment, machinery, etc. They are physical items. You can touch them. I can go to my office and I can touch my computers. I can touch my file cabinets. They're physical. They exist. I own them. And I use those items in my normal operations, yet those items are not what I am in business to do. I have to have my computers in order to perform the accounting and tax task that I do, but they're not what I'm in business for. I don't offer to sell them as a normal part of my business. In my business, I don't offer to sell them ever. Once the computers are outdated and I must replace them, I generally strip them and then donate them on to schools or daycares or something like that. Other companies who have assets that have value at the end of their useful life may offer those for sale, but it's a sale outside of their normal course of operations. So how do we classify these things? How do we decide if it's a fixed asset, if it's an expense, if it's an investment? What do we do? What questions do we ask? Because in accounting, asking the correct questions is always necessary. First of all, we need to know if it is going to be long-lived. Is it going to last more than a year? Then we need to ask, is it of significant value? And I always use the example, the trash can in my office has lasted way longer than 1 year, but it was not of significant value. So you have to know, is it of significant value? Is it used in normal operations? If I buy computers, I use those daily. That's normal operations. If I buy something else that is a long-lived asset, but it's not used in my operation, let's say I found a piece of land, maybe one of my clients had a piece of land for sale, and the price was really, really good. So the business bought it. Well, that land is not used in normal operations, and my hope for that land is I'm going to sell it some point in the future. It then becomes an investment, not a fixed asset. On the other hand, if I bought that land in order to build a new office, that would become a fixed asset. We also need to understand the various costs that are involved in acquiring those fixed assets, those items that are long-lived. Let's look at machinery. It's not just the cost of equipment that we're going to capitalize. And that word capitalize, and you'll hear business people talking about, well, did you capitalize or expense that? If I capitalize something, I'm making it a fixed asset and showing it on my balance sheet versus my expense, my profit and loss as an expense. So when we buy equipment and machinery, everything that is involved in getting that item to the business and ready for use becomes part of its cost. And you'll see quite a list here. And there's a list also here for buildings and land. If we were building a building rather than purchasing a building that's already there, you might have an account called construction in process where all the cost of building that facility are gathered so they can be transferred as one cost to a fixed asset account, perhaps titled buildings. How do you decide once the item is in service if we are going to add additional expenditures to the capital expenditure or to the fixed asset itself, or if we are going to expense that expenditure as part of our profit and loss statement? Revenue expenditures are repairs and maintenance. Let's say I buy a van for delivery for my business. The cost of the van and all of those things associated with that become a capital asset. But my oil changes, the tires, the, tune-ups, whatever else that van needs for maintenance become an expense or part of my revenue expenditures. If the benefit for that item is only for the current period, it's a revenue expenditure. If though the expenditure is going to improve the asset, it's going to cause that asset to be useful for a longer period of time, then we're going to increase that fixed asset. This is an example, a flow chart of some of the different revenue and capital expenditures. You may want to get a little familiar with this because I believe there are probably some exam questions and maybe some homework items that this applies to. Now, The fixed assets that we buy, whether it be a car or a building or equipment, machinery, once we've purchased them, they're no longer, after we start using them, they're not as valuable as they were the day we purchased them. They depreciate. One of the rules of accounting says that all our items are entered into our books at their cost. For instance, my great aunt Sally sold me a van for the business for $5,000. The fair market value of that van was $15,000. It gets entered into my books at $5,000, the actual amount that I paid for it. Our accounting records are based on fact, not what we think. But we know that when we buy something and begin using it, its value decreases. Another accounting principle says once it's entered at cost, we don't adjust that cost. Okay, I'm confused. Well, I'm not confused, but it's probably confusing. We know, based on other accounting principles, that we're supposed to match our expenses to the period in which they were incurred, the matching principle. We also know that when we buy fixed assets, that we put them in the books at their original cost. We also know that we're using those items as part of the business and that they're losing value as we use them, but we can't change the original cost. Wow. So what do we do? Well, we accountants who can find a way to figure out anything have come up with depreciation. Depreciation is not a method where we're trying to adjust the value to fair market value, but it is a method where we regularly and equally determine what portion of that asset has been used up by being used in the business. We can't measure it. The desks I own do not become shorter as I use them up. We have to have a way to estimate that usage. We also know that we cannot decrease the cost of that fixed asset, so we've come up with another way to do it. It's another contra account. Do you remember from the last chapter, our contra account called allowance for doubtful accounts? Well, now we have another contra, and contra means opposite of. Think of contrary. Did your mama ever tell you you were contrary? And what did she mean by that? She meant you were being opposite of normal. Well, a contra account is opposite of normal. Just like the allowance for doubtful accounts was a negative number, which reduced our receivables so that we could show a net receivables, a accumulated depreciation account is a contra asset account so that we can show the net value of our fixed asset without reducing the fixed asset itself. Pretty clever, huh? Accountants make rules and then they make ways to get around the rules. But please don't tell another accountant that I ever said that. So on the profit and loss side, we have a depreciation expense which records the depreciation for a particular period of time. On the balance sheet side, we have an accumulated depreciation account which shows all of the depreciation to date. Two types of depreciation, but generally when we're talking about depreciation in accounting, we're merely talking about the equation and the type of depreciation that we use. Things we need to think about when we're calculating our depreciation. What was the asset's initial cost? And we've already talked about that. Items that we buy are in our books at their cost. How long do we expect that item to last? They don't last forever, and in order to calculate depreciation, to come up with an equation for that, we need to know how long we expect that item to last. Now, this is not something that you have to come up with on your own. There are books of classifications and useful life of fixed assets. What do we think it will be worth at the end of its useful life? Now, many items, my computers for instance, are not worth anything at the end of their useful life. They're generally 3 or 4 years old, and there's many new generations of the operating system, the hard drive, etc. by the time I'm ready to replace them. So their value is very little. But equipment, if nothing else, it has a salvage value for the steel and the other metal that is in equipment. Cars generally have a trade-in value or a resale value. So we have to estimate its residual value. So in starting to form the equation for depreciation, we need to take the initial cost less what we believe to be the residual value, also known as salvage value, also known as trade-in value, to find the cost that we can actually depreciate. We're going to look at two methods of depreciation in this chapter. If you read my written lecture, you will also be introduced to a third method of depreciation. Although I will not test you on anything that is not in the textbook, being familiar with that third method called units of production would probably be a good thing for your future in business. So we're going to look at straight line depreciation and double declining balance depreciation. You can use different methods of depreciation for different assets and even different assets within the same class. Straight line depreciation is the easiest to calculate. It assumes that the item depreciates at the same rate over its life. So once you've calculated the depreciation, it is the same for each accounting period. And we use the cost minus the residual value to find the depreciable value. So to calculate your annual depreciation, cost minus residual value divided by the useful life. It's a fairly straightforward and easy method to use. So, assumption. We bought a $24,000 something, let's say a car. We estimate that it's going to have a 5-year life, and it will have a $2,000 residual or trade-in value. So to calculate our depreciation, we take the $24,000 minus the $2,000 and divide it by 5. Our annual depreciation is $4,400. When you have reached the 5th year and calculated the depreciation for the 5th year, the net value of that asset will be $2,000. We never depreciate below the residual value. Double declining balance method. This is an accelerated method of depreciation. That means that in the beginning years of the asset's life, it is depreciated more rapidly than in the later years. Think of a vehicle. You drive it off the lot and it immediately depreciates a whole lot. I know I just bought a new Ford Escape, and if I had turned around after I bought the car, driven it around the block and brought it back and said I did not want that, they would not have given me the purchase price for it. Many items depreciate faster in the beginning and slower towards the end. There are 3 steps for determining the depreciation in this method. First, we must determine the percentage using the expected useful life. Then we multiply that rate by 2 if we're using double declining balance. And then we compute the depreciation by multiplying that rate by the book value of the asset. I want you to note that. Book value of the asset. We're not looking at cost minus residual value in this particular step, but we still will not depreciate it below that residual value. So let's assume we bought that same $24,000 asset. It has a 5-year useful life with the same $2,000 residual value. So our straight line percentage is 20%. We always assume 100% divided by the useful life. So in this case, that's 20%. We multiply that 20% times 2. We then take the book value. So what is book value, you may ask? Book value is cost minus accumulated depreciation. So in year 1, there is no accumulated depreciation. So our book value is $24,000. So $24,000 times 40% is $9,600. A significant amount more than we depreciated first year in straight line depreciation. Now let's look at this. This is a chart that shows us the double declining balance method. Year 1, book value, cost minus accumulated depreciation. And since there is no depreciation at that point, we have 24,000 times 40%, which gives us 9,600. For the next year, we take our book value, which is cost, 24,000, minus our 9,600 to get our book value of 14,400 times the 40%. Look at how much less the depreciation is in year 2 and year 3 and year 4. Now let's look at year 5. If we took the $3,110.40 times 40%, we would have a number greater than the amount that is showing in depreciation for the year. It would be around, I'm trying to guess here, let's see, 312, it would probably be about $1,300. But we cannot depreciate below that residual value. So the most that we can take in depreciation in year 5 is the amount that will reduce the book value or the net value to $2,000. It's very important that you watch this so that you do not depreciate below the book value. This is a comparison of the methods. At the end of 5 years, we have the same amount of depreciation. But the way we got to that total is very different if you compare year to year of both methods. For tax returns, for the IRS, they use a different depreciation system. It's called MAKERS. There's various classes that IRS has determined and rates for each of those classes. Residual value is ignored, and they're always assumed to have been taken out or put into service in the middle of the year. If you go into any sort of tax accounting, you'll learn more about this. Now, with assets, there are times that we are going to sell those assets or discard them because they're no longer useful to us. It might be because the item has become obsolete. It might be because we want to buy the newer generation of that product, or we want to trade it in on a newer version. In order to do that, we have to remove the book value from the accounts, which means removing the cost and the accumulated depreciation. But before we can do that, we must make sure the depreciation is up to date. I would love to tell you that we always dispose of assets on January 1st, but we all know that's not true. So we have to determine, based on the date the item was sold, traded, or discarded, what the depreciation is up to that date. So let's assume we have a $25,000 fixed asset that is fully depreciated and there was no residual value. We're just going to discard this. It's being dumped, trashed. There is no sale price. There is no salvage value. The entry to remove that item would be very simple. we're simply going to reduce our equipment by the $25,000 and reduce our accumulated depreciation by the $25,000. Now remember, accumulated depreciation is a negative number, so to reduce it, we would use a positive number. Okay, now let's assume we have a $6,000 fixed asset with $4,750 of accumulated depreciation as of December 31st, and it's discarded in March. The first thing we need to do is calculate our depreciation up to the disposal date. So we're going to calculate and determine that 3 months of depreciation is $150. So we will make our entry for depreciation. We will use a negative number in accumulated depreciation and a negative number in retained earnings / depreciation expense. We will then remove the equipment and the depreciation from our books. Our equipment cost was $6,000, so we'll reduce our equipment by $6,000. Our accumulated depreciation to date was $4,900, so we'll reduce our accumulated depreciation. What's the matter with that entry? It doesn't balance. The difference of those two numbers will reduce our retained earnings, and it will be in an account that we will call loss on disposal of equipment. Sometimes we can actually sell our fixed assets. It's very similar to discarding a fixed asset, but we also must record the cash or other item that we might have received for the sale. If we sell a fixed asset, we can have a gain or a loss. And that gain or loss is not determined by the original cost of the item, but it is determined by the book value of the item. So we're going to sell some equipment that cost $10,000. Been depreciated using straight line. It's sold for cash on October 12th of the 8th year of use. Accumulated depreciation as of the end of the prior year is $7,000. So we're depreciating at 10% per year. There is no salvage value, so our depreciation is $1,000 per year. Through the 7th year, our accumulated depreciation is $7,000. We need to record our depreciation through October of the 8th year. Now, since it's October 12th, we're going to look at our depreciation for, trying to figure this out in my head, 10 months. 9 months. We're going to use 9 months because it is before October 15th, the middle of October. So we're going to record our depreciation as our first entry. That makes our accumulated depreciation $7,750. We then need to record the sale. Our book value at this point, $10,000 minus $7,750 $750 is $2,250. We're selling the item for $2,250. Its book value. So our entry would record cash at $2,250. We're going to reduce our equipment by 10, and we're going to reduce our accumulated depreciation by $7,750. This slide is incorrect. The accumulated depreciation should not have a minus on it. There is no gain or loss on this sale. If we sold that very same item for $1,000 instead of book value, we would have a loss of $1,250. If we had sold the item for $2,800, excuse me, we would have had a gain of $550. There are some items that may be owned by a company that we cannot use traditional depreciation for. Those are natural resources, and in that case, we use what is called depletion rather than depreciation. Let's say a company buys land and there is coal or oil in that land. As that is extracted, we need to be able to depreciate the value. So we're transferring the cost of those natural resources to an expense account, just like we transferred the cost of equipment or other items, vehicles that the business owns, from balance sheet accounts to expense accounts. It is determined as follows: the cost of the resource divided by the estimated total units of the resource. That becomes our rate, and then we multiply that rate times the quantity extracted, which gives us our depletion expense. So we paid $400,000 for the mining rights to a mineral deposit estimated to be 1 million tons of oil, not oil. So our depletion rate is the 400,000 divided by a million, which gives us $40 per ton. Each accounting period, we will be given the number of tons that have been mined, and we will multiply that times 40 cents. So if we had 90,000 tons times 40%, our depletion for the period is 36,000. We will use an accumulated depletion account and a depletion expense for our income statement. Businesses own assets that are not tangible. You cannot touch them. Examples of those assets are patents, goodwills, those types of items. They do not exist physically, but they do provide value to the business. We account for them as we do other fixed assets. But instead of using depreciation or depletion, we use a process called amortization. Now, I was told that if you could say amortization correctly 3 times, you were a true accountant. I can't do that. What are patents? That's exclusive rights to produce and sell goods with unique features. How do we cost a patent? It's the cost to purchase the patent, legal fees, anything associated with obtaining that patent. We then write that off over what we believe to be the useful life. And it's done via the straight line method. Now, what is its useful life? It can be either the legal life of the patent, or it can be what we believe to be its useful life. Now, in this age of technology, many patents are useless after a few years because technology moves so quickly. So we have to determine what its useful life is. Is it the full legal life of a patent, or is it just a few short years? And we compute this using a straight line method. Cost divided by useful life. So, we have patent rights for $100,000. The patent is good for 14 years, but we only believe it's going to be useful for another 5 years. So we will take $100,000 divided by 5 to find our annual amortization. There is one thing different about amortization. We do not use a contra account. The intangible asset is reduced itself and not via the use of an accumulated account. On the income statement, we use an account titled amortization expense. Copyrights, trademarks, those kinds of things. Copyright, the right to publish and sell, artwork, books, music. The cost of that copyright, like with other fixed assets, includes all the cost of creating the work plus any cost in obtaining the actual copyright. What's a trademark? It's a symbol used to identify a business. What's Nike's symbol? We all know many trademarks. What's McDonald's trademark? The golden arches. What is goodwill? Goodwill is difficult to describe, actually. One of the biggest assets of my business is my reputation and my client list. Yet neither of those appear on my books. The only time that goodwill will show on a company's books is if they have purchased another company. If I ever sell my business, what I am selling is my name or the business name and my client list. The computers I have, the desk I have, the file cabinets I have are of very little value. What is of value is the name and the client list of my business. So if a company bought me, when they went to record that purchase on their books, they could not record fixed assets, like if they had bought a plant, a manufacturing plant, they would record the amounts they paid for the equipment and those sorts of things, the inventory. When they're buying my business, it's not for sale, by the way, they would be buying this intangible asset called goodwill. So they would record it on their books as goodwill. For accounting purposes, goodwill is not amortized. See, I didn't say it right that time. Goodwill sits on the books until we believe that future value has become impaired. And that impairment can come from a number of reasons. It's just simply been on the books for so long that nobody remembers that it was actually Hudson Business Service. The worth of that has now moved to the company that purchased the business. Or it can become impaired because the prior owner did something really, really bad, and that name no longer holds value. Of intangible assets, goodwill is the most often presented on financial statements, most often reported. And if you've paid attention to the news, you know how often companies buy other companies. So that goodwill is always trading hands. You may want to take a moment and review this slide. This reviews the various intangible assets that we have briefly covered. Now, how do we report depreciation and amortization and depletion on our financial statements? First of all, they're not lumped into one account. Each gets its own line item. And in our notes to our financial statement, we disclose how we calculated. Did we use straight line? Did we use declining balance? The description of, or the disclosure of our methods should be listed. On the balance sheet, we should report each class of fixed assets. We might have a fixed asset account called equipment. We might have one that says vehicles. We might have one that says furniture and fixtures. So each class of assets, fixed assets, is listed separately. The accumulated depreciation is also reported as a contra account, and then the net amount of those assets is carried over into the total columns of the balance sheet. Here is an example. So that you have your total property, plant, and equipment, but you also show the detail. And as I noted with intangible assets, there is no accumulated account. The items themselves are reduced. So, as we've seen in each of the chapters, we're going to look at some ratios that will help us analyze what we have just studied. The fixed asset turnover rate measures how efficiently a company is using its fixed assets to generate sales. What is the purpose of the equipment if not to produce items for sale? So this is a method for determining if we're doing that efficiently. So we take net sales divided by our average of net property, plant, and equipment. And as we've seen before, to get those nets, for net sales, we're going to take revenue, less returns and allowances, and less discounts. And for the average of net property, plant, and equipment, we're going to take the beginning book value of our fixed assets plus the ending book value and divide by 2. Here is an example. Net sales, year 1 and year 2, and our beginning and ending property, plant, and equipment. So our average in year 2 is $20,265. Our average in year 1 is $20,370. Now, do you remember the formula? We're going to take our net sales and divide by the average. So our fixed asset turnover rate is 1.73 in year 2 and 1.56 in year 1. So we're increasing our fixed asset turnover in year 2. So the company, in easy terms, we can say that the company generated $1.73 per dollar. We generated $1.73 of sales per dollar of fixed asset. A high or increasing turnover rate is favorable to the company. So we generated more sales per dollar of our fixed assets in year 2 than we did in year 1. And that is the end of chapter 7. Please review the written lecture and other items that I have posted for your help in this chapter.